It's 9:30 a.m. in New York. Thousands of retail traders are squinting at lagging platforms, trying to trade human psychology. Meanwhile, algorithmic volume is processing millions of dollars in milliseconds, dictating exactly where the market moves next. If you are still looking for classic chart formations like a head and shoulders, you are actively being hunted. Institutional algorithms now use those recognizable retail patterns as traps to induce early buyers and sellers. This split-screen diagram illustrates why latency is a portfolio killer. On the left, a 100-millisecond delay from a legacy platform means your order arrives too late, guaranteeing execution slippage. On the right, a direct connection hits the target price exactly. This requires a hard reset. Spend 2 years unlearning retail habits, or 30 days building institutional systems. Success in modern markets isn't about predicting what other humans will do. It requires upgrading infrastructure and logic to survive an algorithmic battlefield. Week 1 starts with a mandatory technology upgrade. We abandon legacy software like MetaTrader 4 entirely and move to modern, trading view-centric execution. Trading directly from your charts through direct integration brokers is now a requirement. This is how you prevent the 3 to 5 pips of slippage that normally drain accounts during high volatility environments. This line chart shows a classic retail triangle pattern, but the actual story is in the glowing clusters outside of it. Those are liquidity pools, massive collections of retail stop-loss orders. Price action uses that liquidity as fuel, actively hunting it down. Instead of drawing shapes, we look for a market structure shift. This is the moment algorithms finish their hunt. The price sweeps through those stops, collects the liquidity, and immediately reverses the dominant trend. To filter out fake moves, we require displacement. The reversal can't be a hesitant drift. It must break the previous structural low with a heavy, energetic candle. This confirms the smart money is actually selling. By tracking liquidity rather than shapes, you stop being the prey and start aligning your entries strictly with institutional momentum. In week 2, you stop trying to grind the market 24 hours a day. The modern tape is too efficient for constant trading, so we restrict execution to a specific time price window. You operate strictly inside the New York kill zone, between 8:30 and 11 a.m. Eastern Time. This 2.5-hour window provides the highest probability setups of the day. You also adopt the hybrid account model. You maintain a micro-personal account to practice emotional control, while simultaneously running evaluations for prop firms that provide access to 6-figure capital. Moving into week 3, you start handling volatile assets like gold. Surviving these massive daily ranges requires a rigid mathematical defense. Looking at this equity visualization for a $10,000 account, we apply the fixed fractional risk model. Whether your stop loss is tight or wide, your position size is calculated so that a loss results in the exact same $50 deduction. You risk 0.5% of your equity per trade every single time. Confining your execution to a 2-hour window and strictly capping your risk at fractions of a percent physically prevents the emotional blowouts that destroy beginner accounts. Week 4 is your final test. Jumping straight from a demo environment to a live funded account is a psychological recipe for disaster. We abandon manual spreadsheets and use AI-driven journaling tools. They sync directly with your account to objectively pinpoint your psychological leaks and statistical failures. This automated audit channel generates a strict 3-box checklist. Before touching live capital, you need 20 consistent setups for statistical significance, absolutely 0 violations of your risk limit, and 0 trades placed outside the kill zone. Relying on a rigid audit strips away human overconfidence. You only deploy real capital when the math proves you are ready. Over 30 days, you transition from a retail trader guessing at patterns to a disciplined operator reading the algorithmic tape. You don't need to be right every time. You just need a statistically significant, repeatable process backed by flawless risk management. By completely overhauling your technology and logic, you separate yourself from the outdated habits of the 90% who fail. The modern infrastructure is already built and ready. The only variable left is your discipline to execute the plan. Download the 30-day foundation checklist. Integrate your charts with FXNX's 0-pip